All right, everybody. Good afternoon. I'm Melissa O'Hara, part of the LeadHERS Planning Committee, and I'm really thrilled to be with you here today about this topic around understanding your finances at every stage for an abundant financial future. And we really have an exciting program today. Let me just go over a brief agenda and what we're going to be covering today. So here's our welcome. We'll be giving you a little bit of information about the United Way and specifically about Women United, who's sponsoring this event today. We'll then move into our moderated panel where we really are encouraging you to ask questions through either the chat, raise your hand. We want this to have a lot of interactivity and make sure that we get the topics that are top of mind for you. We'll then conclude with a little bit about upcoming events and a little bit of a closing. So that is our agenda today. Without further ado, I'm going to turn over to Brandon to give us a little bit more information about the United Way and how it supports our local community. Brandon?
Thank you, Melissa, and thank you all for joining us today. My name is Brandon Emerson. I'm the Chief Philanthropy Officer here at United Way. I'm thrilled to be partnering very closely with Women United and our panelists to bring you this program. Before we jump into that, I just wanted to provide you all with a little bit of information around United Way's mission. For more than a century, United Way of Central and Northeastern Connecticut has been at the heart of our community, but our work's far from done. The stark reality really is that 1 in 3 households in our region are living in extreme or working poverty. And the other figures that you see here on the screen aren't just statistics. They represent real families facing real challenges in our 52 service communities across central and northeastern Connecticut. The gaps in child literacy, housing, wages, and life expectancy aren't random. They're interconnected challenges that require a comprehensive approach. Our vision goes beyond temporary relief, and we're working towards real equitable solutions where everyone in our region can succeed. With over 100 years of experience and deep community roots, United Way and our strategic partners are uniquely positioned to address these challenges, not just with quick fixes, but with transformational solutions. Our strategic plan focuses on 4 critical areas where we feel we can make the most impact in ending poverty. In child literacy, we know that when a child reads at grade level by 4th grade, they're more likely to graduate high school on time and achieve financial stability as adults. Last year alone, our child literacy programs reached more than 2,500 children, setting them on a path to future success. When we think about wages, skill training and career advancement are key to helping people move beyond working poverty. Our workforce development programs help adults gain skills and certifications for in-demand careers and family-sustaining wages. That leads to stable housing, which we know is foundational to everything else in life. Our housing initiatives have connected hundreds of individuals and families with resources to remain securely housed, providing the stability needed to address life's other challenges. And it's unacceptable that life expectancy can vary dramatically between neighborhoods in our communities just miles apart. Our health equity initiatives are working closely to close this gap by connecting thousands of residents with preventative care and resources. These 4 focus areas aren't separate, they're interconnected strategies that help us truly address the root causes of poverty in our region. We couldn't do this if we didn't have a very clear point of view on how. What sets us apart isn't just how we do it or what we do, but how we do it. Our approach is built on these 4 principles: aligning our communities, bringing together corporate, government, and philanthropic partners around shared goals. No single organization can end poverty alone, but by aligning our efforts, we're creating collective impact that's greater than the sum of its parts. We leverage our century of expertise, experience, data, and community voice to deepen our impact. This means using what we know works, learning from what hasn't or doesn't, and constantly evolving our approach. Connect people with resources and opportunities to make a difference. This means both connecting to those in need with services and connecting those who want to help with meaningful ways to contribute. Ultimately, we're focusing on transforming the future with game-changing solutions. This means going beyond basic aid and creating lasting change for everyone in our region. Perhaps most importantly, our approach is extremely community-centric. Through our strategic planning process and our current work We've engaged residents with lived experience in co-creating these solutions. As one participant in our design sessions noted, the unique part was to look at it from the point of view of someone we're actually serving. That allowed us to zoom in on those critical needs and understand how to address them. Today, you'll experience a strong program that's meant to help you all build financial resiliency. And I'm pleased to introduce our Women United Chair, Jen Shanley, to speak about Women United and how it's a core part of advancing our mission.
Thanks, Brandon. Hi, everyone. I'm so glad to see you all here today. And so I'm just going to give a brief overview of Women United. So as many of you know, Women United is a global effort of more than 70,000 women. Women United is also engaged in more than 165 communities across 6 countries. And globally, since 2002, Women United has raised $2 billion. And this is focused on education, financial stability, and women's health. Our local Women United serves the greater Hartford region, and we focus on raising funds for United Way supported initiatives that really help close the financial gaps for local women and their families. So in addition to all the fundraising that we do that allows for the training programs and things like that, since 2011, with money raised from Power of the Purse, we have helped more than 115 local women to save more than 92,000, which is matched by Women United. So it's a total of of about 160,000 in asset purchases. We can go to the next slide here. And I just want to show you the 4 focuses that Women United has, and this is based on what matters most to our members. And those are the 4 you see here. It's women's empowerment, financial capability, asset building opportunities, and family sustaining employment. So the biggest objectives that we have are that women are able to obtain and retain a job that can offer family sustaining wages so they can support their family and they can advance their career. We also want to focus on individuals and families increasing their financial capability to achieve their short and long-term goals. So the program you are about to experience is executed through the tireless efforts of our fantastic LeadHERS committee. This year's committee is comprised of Melissa O'Hara, the president of O'Hara Solutions Group, Sandi Perillo-Simmons, the global head of data governance at AIG, and today's moderator, Maryann Cruz, who is the CEO and business strategist of Masterful CEO. So I will hand it over to Maryann to take us through the program. Thank you all.
Thank you, Jen. So it's my pleasure to partner with Women United members as committed as Melissa and Sandi to bring you such a powerful program today. I'm thrilled to introduce our panel for today's Understanding Your Finances at Every Stage for an Abundant Financial Future. We're joined by our brilliant panelists, Meghan Smith, founder of Smith Law Group, CT, Patrina Dixon, CEO of It's My Money, and Jenna Isleib, financial advisor at Connecticut Wealth Management. Thank you all for being with us today. And looking at the time, I know that we have a limited amount of time together. And without further ado, I'd like to dive into the questions. So ladies, as I address you, please be available. And I'll just wait 1 second until our panelists are all spotlighted, and then we can go from there. There we go. And in the meantime, if anyone has any questions that you would like to ask our panelists, just put it in the chat, and what we'll do is at the end, we will answer and open it up to everyone, okay? So while we often hear people share their personal and business goals, not too many will share their financial goals, right? So Jenna, can you provide us with some examples of short-term and long-term goals and how we should invest our money to reach those goals?
Absolutely. Thank you for having me. I'm excited to be here. I will first disclose that financial goals look different for everyone. Something that I value and want to do might be different from something that Maryann wants to values and wants to do. And it also depends on life stage. So, for example, for me, retirement is a really long-term goal because that's a few decades out. For someone in their 60s, that may be more of a short-term goal. So that's just a little disclaimer. I will say common short-term goals that we see are paying off debt, building an emergency fund, saving up for a big purchase. And for these kinds of goals, the fund should be kept really safe in cash or a high yield savings account or something along those lines. Any goal that's about 5 to 10 years out, we consider a medium-term goal. You can invest the funds for those goals, but should not be super aggressive since you'll need those assets sooner rather than later. For a lot of people, this could be saving up for a house or paying for a wedding. And then longer term goals we think of as about 10 plus years out. So again, this might be saving for retirement, saving for your children or grandchildren's education, maybe saving for a vacation home if you're lucky. These funds have much more of a long-term time horizon, so you can be a little bit more aggressive with these investments and make them work harder for you. But to make a long story short, the thought is that the sooner a goal is coming up, the more conservative those dedicated funds should be invested.
Perfect. Thank you for that. And I love the fact that you said, vacation home. Yes, I will sign up for that.
That's one of mine, hopefully.
Now, in order to achieve one's goals, it's essential to have a structure, right? So, Patrina, what are the key financial principles that every individual or entrepreneur should master to build a solid foundation?
Thank you, Maryann. And I love that you said builds, because I am a huge proponent of having a solid foundation as it pertains to your finances. So when you think of building a home, you have a solid foundation, you build the walls and then the roof. So it's important that you start with what I call the financial fundamentals. So you want to make sure that you understand what's coming in and what's going out. And yes, it's called budgeting. I know a lot of people don't like that word. Call it something else if you need to. Just make sure you do the exercise. I would follow that by, included in your budgeting, you want to make sure that you prioritize your needs over your wants. It doesn't mean you can't do things you want to do, but make sure that you're budgeting for them accordingly. Secondly, I would say saving. It's really important that you save. Even if you're in debt, you can still do that. And then I would also, and those apply personally and for your business as well. If you're a business owner or entrepreneur, you should do these things as well. And then the other thing that I will say is using credit responsibly. So start with budgeting, saving where you should save, and we'll talk about that later, and then using credit responsibly, because ultimately when your credit is at a great number, you'll pay less for things that you need to use credit for. So that's what I would say. And then before I move off, and Maryann, turn it back to you, I want to say, when I say whose money is it, I want you to drop in the chat, it's my money. And I'll tell you why when we get towards the end. So anytime I say whose money is it, I want you to drop in, it's my money. So whose money is it? I want to see some it's my money in that chat.
I'm going to yell it. It's my money.
Hey,
It's
I
my
can't hear
money.
them say it. Yes, it's my money. Well, let me go ahead. I'll be remiss if I did just say why. Because when you think about your money in that way, you'll do right by it. So when you chant it, when you think about that way, you're going to be the best steward of it. You're going to do right by it. You're going to make sure nobody takes it that's not supposed to. You're going to check it regularly. You're going to be passionate about how you manage it. So that's why that brand, It's My Money, is my trademark brand, because that's a community, the way that I want you to feel about these things that we're going to talk about. So whose money is it? Yes, I see you.
It's my money.
Hey, that's what I'm talking about. So yes, so fundamentally start off with make sure you're managing it well. Yes, Ellie, it's my money. Yes, Jennifer, it's my money. Exactly right. And then as we dive deeper into the responses through the panel, you'll see the varying different tips that we all will share with you, will help you along that journey of managing it well.
Thank you, Patrina. I'm actually going to follow right back up.
Oh,
I have a question, another question.
I love it.
for you.
Okay.
So, in building that solid foundation, understanding cash flow is essential, right? So you need to know what's coming in, you need to know what's going out. Why is understanding cash flow so crucial for both personal and business finances, and how can someone begin to track it effectively?
Yeah, so I mean, you laid it right up for me. It's understanding what's coming in and what's going out. And let me tell you, this may not be proper English, but you can't round up or round down, because if you do that, the math ain't gonna math. So I always tell people, make sure you start with the exact amount that you have coming in. So if you make every 2 weeks, your income is 1,327.13, it's not 1,300. It's not 1,200. You have to put it exactly what it is, because when you begin to reduce that income by your expenses, the math is going to be off. Therefore, you're not going to land with the right number. So make sure the math is mathing by using the exact amount. The other way to manage your cash, in addition to managing your cash flow, one of the tips is making sure you use the exact amount, followed by what you plan to spend. Because everybody know the best laid plan can change, right? Like I had every intention to be already at my hotel for this particular session, but I'm sitting in the airport. Guess what? I'm still making it happen. So you have to make sure that you're able to pivot even within your finances. So know what you have coming in personally, or if you're an entrepreneur, from your business, and we know sometimes that can fluctuate. And then you want to make sure that you go back and do what you write in what you actually do. Because if the plan changes, you want to make sure that you put in what you actually do. So start, number one, how much do I have coming in from all sources? What do I plan to spend out? Not just things with due dates like rent, car payment, car insurance. If that car is going from A to B, then you have to put gas in it. That's not a bill. And sometimes we miss that within the budget. So you want to make sure you're including things that do not have due dates, but you know you're going to spend money on. And then lastly, revisit that as often as you get paid, and then go back and put in what you actually did. So really important, those 3 steps. And then the last part of your question was, where do you get resources? So, hey, look up on the screen right above my head. You can get resources there, right? So it's mymoney.info, my website. I have free budget sheets. I have an academy that you can also check out. And then I put a lot of free tips on my social media handle, which is it's my money _. So no matter how much money you make, budgeting is important. Watching your cash flow is important. Know what's coming in and know what's going out. And then you be the dictator of all that, because it's going to spend anyway. Why not you be the dictator of that?
Thank you for that. And as you were saying that, I was thinking, okay, money management, right? And you just stated you be the dictator of that. So I know that when it comes to having that financial structure, it's important, it's imperative to have that money management piece. So Jenna, how involved does one need to be in money management? So for example, let's say that my spouse is handling it because he enjoys it and I stay clear of it because maybe I don't. Should I still be involved? I hear that often. I'd love to hear your answer on that.
Yes, I hear that pretty often as well. And I think that my short answer is yes, you should be involved. Like Patrina was saying, if you're not involved, you can't be the dictator of where your money goes and where it's spent. However, I also know that I am a bit of a finance nerd and not everyone agrees with me. I see my friends and family's eyes glaze over when I talk about finance, so I don't judge the people who don't have interest or don't want to be involved. With that being said, if it's not something you love, it is still kind of a necessary evil where you should still be aware of it. Unfortunately, there are things as adults that we don't like to do, and maybe finance is one of them. But the perks of being involved really, really outweigh the cons of being involved. First and foremost is if you are involved, you know what's going on and you know your wishes and your financial priorities are being heard. Money management isn't just making sure that, the water bill is being paid, though that of course is important, but it also includes making sure that your estate plan reflects your current wishes and making sure that your investments are tailored to meet your goals or your risk tolerance. I will say, especially for people who are married, being involved reduces the risk of financial infidelity. So that's any deception related to money within a relationship. And then the most common reason we see that we want people to be involved is because if a partner handles all the money and then something happens to that partner, like an accident or if they were to pass away, the person who's not involved in that money management is now lost in trying to figure all of this out while in potentially one of the darkest periods of their life. And that is not the time that you want to have to try and figure out your finances. So I have 2 tips for the people who don't want to be involved. One is know just enough to be competent. You don't have to be sitting there looking through every transaction if someone else is doing it for you, but know enough to be able to get by on your own. And then for those people, which we have many, many clients who feel this way, where they're like, I absolutely refuse, I have no interest. We recommend sitting down with your partner or whoever does manage your money and making an in case of emergency plan. And so that is about that lists important contact information, like your financial advisor, your accountant, your insurance agents, so you know how to get in contact with the people who are helping you. Your account information, so you know which money is out there, you know what liabilities are out there. Your insurance policy information. We put this together for a lot of our clients, and it helps those people who aren't involved and who don't want to be involved know that they have a roadmap available to them if the worst were to happen.
Thank you. There was a few things that I took away, and I know that we'll talk about estate planning a little later with Meghan, so I'm glad that she's here, because also as part of the resources and your team, you should have an attorney on there as well. So Patrina, I know that you mentioned, and while we've all discussed like checking and savings, how can we, and money management, right? So money management is having your checking and your savings and other accounts. How can we optimize checking and savings accounts so that we can structure it and have it so that it's growing our financial cushion? I know that Jenna mentioned like an emergency fund. So Patrina, how can we leverage our credit to do that, or our checking and savings accounts, really?
Yeah, so I want to first start by explaining how I define each of those accounts. Your checking account is your operating account. If you work for an employer, typically that's where your money is directly deposited into. That's where you pay your bills from, even if you're paying online. That's money going in and going right out. Saving is putting away money for later. So you want to ensure that you understand how to use both of those accounts so that you don't have large sums of money sitting in what I call your operating account, unless you have to pay varying different bills that are large from that account. You want money that's going to sit around for later to be, and to use your word, optimized by in the appropriate savings account. And that is one that's going to yield you the most for money just sitting there, right? And that's called a high yield savings account. And we'll talk about the ones that I think are ideal that you can check out yourself. So optimizing the accounts is first starting with understanding how you should use them. Checking, money go in, money go out. Saving, putting money in, ensuring that it's growing for you, and if you can automate it to do that as well. The other thing that I will say is people think about convenience when it comes to banking. I want you to unthink that. No longer have that thought. Yes, the bank down the street may be the closest, right? But most people don't go inside the bank. So even if that's the closest, that's the one your mother, your grandmother, your uncle, your husband uses, that may not be the right account for your savings account because you may not be earning the most there. Now, again, operating account, putting money in, money going out. The same like you have money directly deposited from your employer into that operating account, you can do the same into a savings account. Some employers allow you to have your money split in 3 to 4 ways. And that can be a checking account and then a couple savings accounts or whatever your makeup is personally for your family. But the point is the money that's going to sit around for emergencies, for later, for the vacation home, whatever that may be, that should be in a place that is working for you. Having those, you've worked for the dollars, now have the dollars work for you. And that's what I would call in a high yield savings. So that's the way that you can optimize both of those accounts. The second thing that I want to say is optimizing your account, meaning don't let money just frivolously drop out, even if it's a little bit, even if it's $2.99, $3.95, right? And what I mean by that are fees. Going to ATMs that you will get fees from both sides, from your bank potentially and from that particular ATM that you use. Those little bit, what we'll call sinking fees, those add up over time. And especially if you are not looking at your statement, you'll be surprised how that money goes away when you think you may. Remember, I told you the math is not mathing. So if you're only reducing from your budget the things that you plan to pay, and did not take it into account when you revisited the budget, that you had a few fees that came out because you were walking along the airport and you went to an ATM that you didn't plan for, that's not your bank. You want to make sure that you're going back and putting that in, or trying not to incur those fees. And that's why I say managing your money well. So if you're going on a trip, you may need to get some cash out. Your bank that you utilize is not where you're going to be. Make sure you get that money out before you go, or use another source so you're not paying a fee to use whose money? Your money, right? So it's making sure that you are minimizing fees that you think are, oh, that's just happening. Oh, the bank is just doing overdraft protection for me, even though they're charging me for it. They're doing me a favor. No, they're not doing you a favor. They're using and leveraging what they have in place, which is earning money when you are not managing your money. So that's the way that I would think about it. Understanding what the accounts are. So checking, operational account, money in, money out for bills and various different things. And you know what that is because you're budgeting, right? And then and guess what? If you're not doing any of these things today, it's okay. You came here, so give yourself credit for doing that, and then walk away with tips that you will learn here today. And then secondly, saving, making sure that you're putting small amounts. Don't leave here so excited and say, I'm going to put half of my check into the savings if you haven't been doing that, because I promise you, you'll do that on Friday and you'll take some out on Tuesday. So we want you to start small. And then as you see how your budget can allow, you have room within your budget to make that money grow, that savings amount automatically grow. So then you change that amount as you go along, and then you'll be able to sustain money that's automatically going into your savings. So those are the ways that I would say optimize checking and savings first. Defining, knowing how to use them best, and then working accordingly to make sure you're reducing fees that are taking out that are small but grow over time.
Thank you. And as you're saying, checking and savings and high yield savings, I love to see in the chat, like how many are yes, I have a high yield savings. Yes, yes, yes. And if not, then yes, I will, because you need to ensure that you have that little, vacation fund or emergency fund. And while most
May I
of us,
just double think that there were comments on that? May I just add a comment here regarding high yield savings?
yes,
So I want to make sure that when I say online savings accounts, I'm not talking about financial brick and mortar institutions that have online capabilities. I'm talking about straight online accounts like Ally, ALLY as an example, American Express Savings as another example, Goldman Sachs, Marcus as another example. Those are online only savings accounts. You want to make sure that they are FDIC insured, but that those are going to yield you the highest interest for having your money parked in there. So even though you may have your checking account at Liberty, Wells Fargo, Bank of America, Webster, wherever it may be, those are great relationships for that purpose, but that savings account should be connected to it, but adding another place that is not convenient to get to, because remember, that's for other things that you want to do later and have that money grow for you, yielding the most money. And you can go to bankrate.com or nerdwallet.com and find the one that's ideal for you. Again, check and see if it's FDIC insured, check and see what the minimum amount that you need to have in there, because you don't want to pay fees for not having the minimum in there. And most of them are very small minimums, and that you know how to get your money in and out of there. So it's really important to do that. Nerdwallet.com, bankrate.com are places you can compare online only high yield savings accounts. Thank you.
thank you for that. And thank you, Melissa, for putting it in the chat so that everybody has it. And so you said checking, you said savings, and I know that so many of us also have credit cards. So, Patrina, what are some smart ways individuals and small business owners can leverage credit to build wealth and or expand, operations? And then Jenna, if you have a response to that as well, I welcome.
Yeah, so this is what I will say about credit, because a lot of people are like, whoa, oh, credit, I don't like credit. I don't want to use credit. I want to always use cash. Let me tell you something. Good credit is good. Bad credit is bad, right? So it's really important. So you can leverage credit in many different ways on both personal and business. So let's start with personal, right? I don't know if you travel. I travel quite a bit. You can't even rent a car like without a credit card. It's really important to have one. So you want to ensure if you have a credit card, you want to use it responsibly. And responsibly, in my definition, is ensuring that what you are charging on that credit card, you can pay off in its entirety, or at least 70% or more of what you used in a given month. It's really important that you do that. How you figure that out, for an example, if your credit limit is $500, and you use $500, which is actually maxing out the card, but let's just say you did, you can, and at the end of the month or when you get that statement, you can pay off that entire 500. If you're unable to do that, then you want to at least pay 350. That's an example of how to get it down to 30% or less if you can't pay the entire amount. And my folks, you can't just do that on one credit card if you got 5 credit cards. You want to make sure that you're doing that across all. And then that leads me to my next point. If you are unable to manage, because remember, this is about money management, 5 credit cards, don't have 5 credit cards, right? If you already have 5 credit cards, then you want to make sure that you understand what they are, how much you owe on each, when they're all due, and then what the interest rate is on all. And then you begin to create a payment plan to be and incorporate that into your budget to pay down that debt. Now, there's 2 rules of thumbs. You can either do what's called the avalanche method or the snowball method. I like the snowball method. I encourage clients when I used to work one-on-one with clients to use the snowball method. And let me tell you why. The snowball method is where you pay off the lowest balance because you're going to track all the balances to see how much you have. You pay the lowest balance off first. That card, you pay that card off first. And then you take the money that you paid on that card and begin paying off the next one, but making sure that you're paying the minimum balance on all the others. The reason why I like that one is because you get that win. You say, congratulations, oh, I'm so happy I did that. You feel good about yourself because when you're going through this process, you want to make sure that you're getting some wins as you're going along. So as you continue to pay each small balance off, you get that win, that adrenaline. And then I promise you, when you begin to do this, you're not going to want to mess up again. So that's why it's important to get the wins as you go along. The other way, which is avalanche, once you learn how much you owe on each and the interest rate on each, the avalanche method says pay the highest interest rate card off first. So oftentimes that is the one you owe the most on. So when you do that, it will take a little bit longer to get to that I paid it off, but it from a financial standpoint, you will end up paying less if you pay that card off first. It just may take a little bit longer. So that's why I suggest the snowball method, but you can choose whichever one that works best for you and your finances. But the key is to do that, pay off debt, and then get your credit where it's manageable. You're including those payments regularly into your overall budget because you're going to manage your money after you leave here. And then that includes debt payoff or pay, even if you don't have like outstanding large debt, you are managing the cards that you do have or will have. So that's really important that you do that. And when you go to buy a home, when you go to buy a car, when your credit is good, then you will have favorable interest rates, so smaller than if your credit is not good. When you pass like car companies, they're very infamous for this, not car dealerships, but other car places that you may pass by. No credit, no problem. Bad credit, no problem. It's a problem because they will make more money off of you when your credit is bad, because your interest rate will be like 29 point something. So you don't want to be in that situation paying 29% over the price of a car when you can pay 4% or 0% if you have a really good credit score. So that's how you use credit responsibly. Only take on credit that you can pay off. If you're already in a credit situation or you are contemplating, just make sure you're including in your budget what you've used, and that if you cannot pay off a full balance, be below 30% of the amount that you have paid on the credit, or the amount that of the credit limit that's available to you.
Perfect. Snowball and avalanche. Hadn't heard of it before, but I appreciate you sharing that. I wish that there was one that was like sunshine, just so that it's not all winter related. And I know that Melissa actually put it in the chat so that we have that. So I know we still haven't gotten to Meghan, and we're going to get to Meghan soon. So, so many resources have been shared with us, so many nuggets. And if you have any nuggets that you want to learn a little bit more about, please put it in the chat. So now that we have an understanding of the importance in creating financial goals, building financial foundation, leveraging one's credit, Jenna, what are some resources that can assist us in financial planning?
Yeah, we live in a weird time where our issue is actually not that there's not enough resources, it's that there's too many out there. It can be really overwhelming. And of course, everyone has their own opinion on which resource or which financial guru is best. I know I often am talking to my family who has found the hottest tip or trick on Instagram, and they're like, this is what's going to make me a billionaire. So first, I will say beware of those. Beware of those blanket recommendations, which are recommendations that start with everyone should be doing XYZ, or if you're not doing this, you have a problem. Financial planning is really tailored to your specific needs and your plan. Everyone's financial picture looks different. So while there are exceptions to the rule, it's really rare that a blanket recommendation is going to be the make it or break it for you. And the most important thing is if you find a resource or a strategy that works best for you and makes you feel comfortable and confident in your money, that's really the most important thing. And I know my main tip is going to sound a little annoying coming from a financial advisor, but I do strongly recommend using a financial advisor or a planner or a financial coach to help you build out your financial plan, because everyone's plan is so nuanced and specific to their own situation. Granted, I know this field, the financial advising field, can be really convoluted and has a reputation with salespeople who are out there, seeking a commission or trying to make money off of you. And while it's getting better, I know that reputation is still out there. So some tips and tricks for looking for a good financial planner for you is first making sure that the person you're talking to upholds the fiduciary standard, not the suitability standard. So the suitability standard means that I can make a recommendation that is suitable for your financial plan, but doesn't necessarily have to be in your best interest. So if I could recommend that you put your money in a low-cost investment account, or I could sell you a product that's more expensive, works just fine for you, but I also get a 10% kickback. If I uphold the suitability standard, I can recommend that even if it's not the best thing for you. A fiduciary standard, someone who upholds that, has to put your best interest before their own. So that's something that's really important to find, so that you can trust your financial advisor is thinking of you first and not their own personal wallet. The second thing I would look for is fee-based or fee-only financial advisory firms, because that means that the majority, if not all of their revenue, does not come from sales or commissions. Typically, these are firms that charge a flat fee or an asset under management fee, but this way you know that when they're making a recommendation to you, they're not making a recommendation because they get a commission. And then the last thing I would look for is a holistic financial planner. Typically, these are people with a certified financial planner designation. And the reason I suggest looking at this is because a lot of financial advisors only look at your investment accounts. And while that is a really important piece of your financial picture, it's not the only piece. So you want a holistic financial planner who will help you look at your estate plan, your risk management, your investments, your tax planning, and not just the investments in your portfolio. And then they can also help connect you with experts in the field, like Meghan as an attorney. And then, of course, we will be sending resources after this panel with tips and tricks from myself, Patrina, and Meghan. So hopefully those will be resources that you guys can get immediately that will help you as you start this journey.
Thank you. And you mentioned estate planning, you mentioned Meghan.
Yes.
I find that most people don't think about or even consider having an attorney when it comes to financial planning, right? So Meghan, can you share with us at what point should someone get an attorney involved with financial planning so that we understand that it's not simply reading a will?
Now. That would be my answer. Everybody needs estate planning documents. So an estate plan is really more than a will. It's a comprehensive set of legal documents and strategies that are designed to manage a person's assets, but also your health care, and your legacy during your life and after death. So it goes far beyond just having a will. There's much more that is involved in an estate plan. And it usually encompasses, it could encompass a trust. It could encompass a durable power of attorney, which is, I like to coin it as your financial power of attorney because it doesn't cover any healthcare. It covers anything from real estate to financial accounts to dealing with the DMV, anything outside of healthcare. And then you have your healthcare power of attorney, also called an advanced healthcare directive, which is going to give someone the power to make your medical decisions for you. That's something that you need now. What if you're in a car accident and you can't communicate your wishes? If you don't have that document, excuse me, if you don't have that document, then who's going to decide? And then also, if you want a living will is, essentially a do not resuscitate. If you are, in a permanent vegetative state and a physician has determined that if they removed life support, you would pass away, then the document says that you want to be able to go peacefully and you don't want to be hooked up to a machine for the rest of your life. And then we also do a HIPAA authorization because doctors aren't going to give anybody else medical records but you unless you sign a document. So those are documents that encompass an estate plan. And it's more than just what happens to my stuff after I pass away.
Absolutely. When you mentioned estate planning, one of the things that stood out because I hear it is it often encompasses wills and trusts. So what's the difference between a will and a revocable trust?
So a will is a document that states where your assets go after you pass away. You can also choose if you have minor children, and you can also name guardians in that document. A trust is a document that can be used prior to your death and after your death to hold your assets. It's actually an estate planning tool where you convey your assets into this trust. So you do still need a will if you have a trust because there's always a chance that you forget to put an asset into a trust. And we also typically don't recommend that you put your vehicles into a trust because it could expose your portfolio if there's a car accident and you're liable.
Okay. So what are some of the benefits of the trust?
So the trust is great because you can determine how your assets are distributed. It's great for if you have younger children, but it can also be used if you have an older child who may not be financially responsible, like an adult who may not be financially responsible. And they're very customizable. So if you wanted your child to, inherit money at certain ages, we will put in, they can take a lump sum, a smaller amount at age 22, larger amount at 27, the rest of it at 32 when they have reached what we hope is financial maturity. I have some clients who have done it all the way to 60. I have some clients that will require their child to enter into a prenuptial agreement before they have access to their principal of their trust. There's so many different ways that you can protect your beneficiaries from losing their, and spending their your legacy, essentially what you're leaving them. It's also private. So when you pass away, a will gets admitted to probate and it's public record. Your trust will also have to go to a probate, but nobody can see that trust. The only person that can see it is your beneficiaries. So for people out there that are very private and keep things close, they don't want anybody to know anything about their, finances or who, personal life. This is a great tool to keep that private. And then finally, and most importantly, it's a smooth asset transition and provides for continued access to money when you pass away. So if you pass away and you don't have a trust, and whether you have a will or no will, any money that you own in your checking accounts gets completely frozen. So if you are, say you're a single parent, and you pass away and all of your money was in your checking and savings accounts and it's just in your name, nobody can touch that until probate is opened, a fiduciary is appointed, meaning an executor or an administrator if you don't have a will. And then that money has to be taken out and put into an estate account. And it's subject to creditors. So if you have a trust and you retitle the trust into the name of, or you retitle the bank account into the name of the revocable trust, nothing happens. If you pass away, all that your successor has to do is accept the appointment as successor trustee, and then that money continues to flow as it did before. So as you can see, it can avoid quite a bit of headache for your family, when they're already grieving after you pass away.
Absolutely.
And then the final thing too, I'd also just want to mention is that in your trust, you can also, it doesn't have to be individuals, you can also provide for gifts to charitable beneficiaries. And you can do that in a revocable trust. You can do it in a charitable remainder trust, which is an irrevocable trust. There's all different ways to provide for if you have goals to donate to charities that way.
Fantastic. And you said donations, so I automatically think United Way.
Yes.
So, and I promise I'll stop after this question, and then we'll open it up to questions from the audience. But you mentioned, will is basically open, right? And the trust is private. So can the trust protect my assets if I was in need of Medicaid or Title 19?
So the only way to protect your assets from that is if you transfer them into an irrevocable trust called a Medicaid Asset Protection Trust. You have to give up complete control of everything. For your house, Connecticut does have a high exemption for that. However, it doesn't mean that the state won't come after your estate for recovery purposes. So if you are, nearing retirement age and you're concerned about protecting, people's homes are often their largest asset. If they're concerned about protecting their home from that, they can convey the property into this trust. They would not have control over it anymore. Whoever the trustee is, they cannot be the trustees of the trust. When you do a revocable living trust, you are the trustee until you pass away. With this type of trust, you would not be the trustee and you're not the beneficiary. You still have the right to live there. It provides for that, but that's one way to protect your asset. Retirement accounts are a different story. There's not really any way of getting around that for that. But the other thing I did want to mention when I'm talking about retirement accounts is number one is always check to make sure that you have a beneficiary and a contingent beneficiary. I had a probate that I just wrapped up where the woman had an IRA. She had $70,000 in her IRA and she didn't put a beneficiary on it and she passed away. So all of that money went into her probate estate. You want to take a guess at how much she had in credit card debt? $70,000. Those creditors have to get paid by the estate. So if there's an asset there. So I was able to negotiate it down in half. So the family only had to pay 35. But the failure to pick a beneficiary cost that family $70,000. Well, 35, I guess, if you count. So it's very important that you have a beneficiary and a contingent beneficiary on all of your retirement accounts to protect that.
Wow. Thank you. Thank you for that. Thank you all for a riveting discussion. I know that I'm ready to take forward some of the insights that you shared today, and I want to open it up to dialogue to our audience. for any questions that you may have. I see Melissa has her hand up. So Melissa, what question do you have?
Yeah, so this is probably for Jenna and Meghan, a combo one. There was a comment here about elder parents. So Jenna, you talked about the in case of emergency kind of documentation with a spouse. And Meghan, you talked about how to think about the assets as they turn over from a legacy standpoint. How do you have those conversations about things like power attorney and what are your end of life directives? And where are all the accounts? Not because you want the money, but because you don't want the headaches. So how do you broach those successfully with your parents? Any advice?
I'll go first because I think my answer is probably more simple than Megan since she has really the legal expertise. But we do encourage everyone that we work with to make these in case of emergency plans, not only for their spouse, but for, their children or whoever would be managing their estate. And in those plans, we will often recommend that you include at least a summary of your estate documents and wishes, if not your actual estate documents and wishes, just so they know who to speak to and what you want. And as uncomfortable as it is, we recommend everyone have communications with the people they want their powers of attorney to be, their executor, their will, their healthcare power of attorney, because the last thing you want is to be hooked up to tubes in a vent and then surprise, someone's told they're supposed to be making healthcare decisions for you and they have one, don't want that responsibility, or two, have no idea what your wishes are. So as uncomfortable as it is, we really do highly recommend having those conversations as soon as possible, just to make it easier on the person in that position and to make sure that your intentions are recognized.
I think that so the reason that a lot of people don't have any of these estate planning documents is because nobody wants to talk about it. I can't tell you how many friends I have that have minor children that don't have wills because they're like, oh, I don't know who I would pick. I'm like, you have to pick somebody because if you don't, the state is going to pick it for you. So I think, not necessarily talking about the money factor and like the actual assets, but coming from a standpoint where, okay, but what happens if you're in the hospital? Like, you know, going at it from that aspect as opposed to specifically talking about, okay, well, where's your bank account? What's your bank account number? Because then people, if they focus more on the emotional side of it, I think it's easier to have that conversation than it is from, just going like right in and being like, all right, well, where are all your bank accounts? Where's your mortgage statement? Like, oh, I think it's better to approach it from an emotional standpoint.
There's also another question in the chat about donating to nonprofits. And so, because we're here talking about United Way, how do you think about, for any of the three of you, the assets that you have in your philanthropic donations?
I think Jenna could probably answer the donor advised funds question.
Yeah, absolutely. For a donor advised fund, that's a great way to take advantage of gifting exemptions and still give yourself the flexibility of where you want to gift in the future. So a donor advised fund is an investment account that is no longer yours. So it's not in your estate, but you get to dictate where you make gifts to and who those gifts are to. They have to be to charities, so you can't create a donor advised fund and then gift money to your kids. So be very aware of that. But if you're in a high tax year and you want to take advantage of gifting money out of your estate or out of your portfolio in high tax years, or you're trying to get money out of your estate that you want to be gifted to charities, those are great ways to do that. And then as you decide who you want to gift to or where you want that money to go, it's invested in growing and working for you. So those are really, really awesome tools for people who are charitably inclined. And I highly recommend, if it's something of interest to you, talking to an advisor who can help you set that up.
So there's general advisement, and then you'll see in the chat, if anyone is interested in United Way, Brandon would be happy to have a conversation about the funds that United Way has as well. So I think we're just turning the corner. So Maryann, I'll turn it to you to wrap up.
Okay, I was actually going to say we have 5 minutes, so I will be, I believe, turning it over to Brandon. Thank you, ladies, for providing so much information to all of us. Truly appreciate you taking the time to be with us.
Thanks, Maryann. I actually think we're going to turn it over to Sandi to wrap us up, but From me, thank you all for joining. Like I mentioned, I am the Chief Philanthropy Officer here at United Way. So if you are interested in exploring charitable giving as part of your financial planning, please do not hesitate to reach out. I'm happy to be a resource if possible. Sandi, I'll kick it to you.
Sounds great. All right. Well, once again, thank you all for joining us. And most importantly, thank you to our panelists and Maryann for providing such a great afternoon for us with such educational information. Please, as you can see here on this slide, as a reminder, on June 12th at the Connecticut Convention Center, we will be hosting the basically the culmination of Women United's annual fundraising activities with the power of the purse. We've got a couple of great keynote speakers with Andrea Elliott and Dasani Coates. The event starts at 11 a.m. and from 11 to 12, we have a pre-event networking and a silent auction. Always a great opportunity to find some fabulous purses and other great silent auction items and network with other women and men actually who are attending the event as well. And then from noon to 1:30 is the actual event and the luncheon. So if you have not yet purchased your ticket, please do so because we are nearing capacity. So again, thank you all very much and look forward to seeing you at the Power of the Purse.
And for those of you on the screen there's 3 different QR codes. We'll also send them out in follow-up information with the handouts. But if you wanted to contact Meghan, Jenna, or Patrina, then those will go directly to the contact information with the QR codes you see on the screen here as well.